Okay, so next in the training bootcamp for the xBrat range breakout, we're going to look at those specific settings for the xBrat range breakout auto trader, those options and settings. Now this is the most complicated strategy because we have lots of ways to trade those breakouts, and we've got basically some modules to look at different types of trades. So we're going to go through all of those settings and options for each module, and then in the next masterclass we're going to go through optimizing for each of those modules as well. But these are very powerful, especially when you're breaking out, when you have data. So let's go through them step by step. Okay, so the first of the three modules is the opening trade strategy. So this determines the opening range of an instrument automatically and gives it a bias, so whether that's bullish, neutral or bearish, and then looks for a breakout of that opening range in the direction of the bias, unless it's neutral, in which case there's no order. So what we say is, let's look at the, when we look at an opening range of NASDAQ, for example, we look at the first 15 minutes candle of that opening range. We look, the auto trader looks at that and gives it a bias. Does it have a bullish bias? If it does, that's brilliant. It detects that, and then on the next candle, if we break out to the upside, it will take that breakout trade. So let's go through number by number. So number one, as default, all three modules are checked to be enabled. Obviously, unchecking each during optimization will help. More on that in the optimization class. Okay, so here we go. Number two, the max range allows you to stipulate a maximum range of the opening range. If it's too big, a breakout may not have the momentum to continue. Okay, so what we have as default, it's set to 0, which means that there's no maximum range. It could be as big as you like, but when you're optimizing, you need to look at each specific instrument differently. So, for example, a NASDAQ or a Dow or something like that would probably be a max range of say 150. Whereas you look at gold on a 5-minute, you probably need a max range of say 20 or 30. So it depends on the instrument, how volatile it is during that opening range. So number three is the entry quantity. Again, some of these are self-explanatory, but I want to go through every single one. It's the amount of futures contracts you set to enter the trade with the initial order. Default is set to 3. Okay, and you'll learn how that comes about here. But again, you can just change that to 1 if you wish. Number 4 is the entry order type. Again, it's default set to stop market as is the most consistent, but there are other entry option types for trialing during optimization for those sophisticated traders. Number 5, entry offset is the amount of ticks above the opening range for longs and below the opening range for shorts. So the default is 1, but if an instrument's particularly volatile and fast, you may want to consider 2 or 3. So for example, that entry offset is 1 tick above the high for longs, for example, 1 tick below. That's very, very tight, and if it's an NQ, you'd probably at 3 ticks because they move that fast. Okay, number 6, stop loss offset is on the other side of the range of your order. The default is set to 2. Again, that can be adjusted during optimization. So what we're looking at is if you're going long, you're going to, in this scenario, you would be going long 1 tick above the high of that range, and automatically your stop loss will be put 2 ticks below the low. This is where that max range comes in as well, because obviously we're going to be the bigger range we've got, the more risk that we have. So number 7, this helps with the risk, the break-even trigger. So this is a point at which you want the price action to go through to trigger the move of the stop to make the trade risk-free. So this number is adjustable and is in ticks. So for example, if you're on NQ your break-even trigger is say 50 ticks, and when you're optimizing, you can say that most, majority, 80% of those trades go through 50 ticks straight away. So that would be as soon as your price action in your open trade goes through 50 ticks, your stop gets adjusted to risk-free. So next is the number 8 is the break-even offset. So when the break-even trigger is activated, you need to decide where to place your stop. Okay, so you need to, obviously, if you're going long, put it above the entry. If you're going short, put it below the entry. You may choose, for example, that you want to place the stop 10 ticks to lock in a little bit of profit. So you want to, so if you're on NASDAQ, for example, you've gone through 50 ticks, you're going to put your stop straight at 10 ticks. Because if it does come against you, it takes it out, it's risk-free, takes a little bit of profit, covers your costs. And that's the sort of thing you'd be looking at. Or if you've got a really break-even trigger, say at 5 ticks, and you're going really aggressive on oil, you may only want to put that break-even offset at 2 ticks. It still covers your costs, but what you're looking for is a runner. It gets to 5 ticks, it's risk-free, you're safe, and you're just looking for it to run. So there's lots of options there. Number 9, the exit mode. Default is target. So this is a set target strategy that you decide on the below options. The confirmation option uses the manager ribbon. So that's 2 EMAs to manage the trade if it is in the direction of the trade. If not, the trade will automatically turn to the target option on its own. So this option is preferred when you're looking for runners, but happy with the times that it comes to take those little profits at the break-even offset you choose. So we'll cover more than this on a chart soon, so you can understand the difference between target mode and confirmation mode for that exit. So number 10 is target quantity 1. So if you're on the target mode, the number of ticks you want the auto trader to take the profit at the first target. So for example, you want one contract, so that's target quantity is the 1 contract to take off. So earlier on at number 3, we said the entry quantity was 3. So you want the first contract, quantity 1, taken off. At 11 is the distance in ticks. So you want at 10 ticks to take profit on 1 contract. And then we go through. Number 12, we've got the target 2 distance. So at 20 ticks, you want to take your next contract off. And then so on and so forth with target 3. You want to take your last contract off at 30 ticks. So number 13, confirmation fast period. Number 14, confirmation slow period. So this is for that confirmation exit mode. And we, as default, set that at 5 and 13 EMAs because that's how we've back tested this. That's reasonably aggressive. You can change that to 11 and 21, for example, to be a more conservative. But when these break out and they run, we want to be reasonably aggressive with that confirmation fast period. And this will make more sense when we actually look at it on a chart. So the confirmation shift at number 15 is the amount of candles when we shift the EMAs to the right. So the manager ribbon always is out in the future, so we can react to moves that make the 2 EMAs cross back. So when you look at that on a chart, those EMAs will be out to the right where there's no candles by 4 candles. So when those EMAs cross, we can react quicker and take those trades out. So let's have a look at the chart here. So first chart is an opening trade with target. It's a very, very simple setup. This is on oil, so it's set on a 5-minute time frame. We can see here we get the opening range defined. This is the first candle. The little tag on here that says oil is green, so and the actual bias of the range is coloured in green. So we're only looking for a long. We go long with long entry here with two contracts at $92 dead. Okay, it takes it in. The first target is hit at 92.15, so that 15 tick target is hit, and that first contract is taken out and profit is taken. And then the second contract is hit out at 92.50, so a 50 tick target was hit, the profit was taken, and the trade was closed. So again, you can see down at the xBrat algo range breakout P&L here, we can see that first profit was taken at this point, and then the next target was hit and the profit was taken there. Very, very simple, and that's the target trade. You can see here the two EMAs that we talk about for confirmation. So even though this may have been set on confirmation, on the signal candle, the yellow was below the red. It has to be above the red to be in a bullish state. So it would automatically go to the target strategy. Okay. So now we have an opposite trade. So this is micro oil on the 5 minute. It's a short, but what I wanted to do here was show you the trade as it moved. This was, these screenshots were taken live. So what we have is we have the oil range defined. This time the tag is in red. The range's bias is red, so we're only looking for the shorts. So we got 3 contracts initially taken short at this point here. The first contract was taken out. That break-even trigger was triggered, so that the break-even stop was put at this point here. Can you see that? So we're now risk-free. Then the second target was taken, still leaving the third target at 93.78. Fast forward in time, we can see target 1, target 2, target 3 was hit, trade was closed, and that stop would have been taken off. The order would have been cancelled. So it's a very simple process in that you've said at a certain price, a certain movement of ticks, you will get the break-even trigger, and that break-even trigger will go to here. At the point in which that happened, there was probably two contracts on there, but this second contract was taken here, so that order would have been adjusted automatically by the auto trader just to have the trading stop on the remaining contract. So very, very simple. So next, the confirmation trade. So these are the ones we really get for those runners. So this is YM on the 15 minutes. So as you can see with YM, for example, with all the indexes, we use the 15 minutes. So that first 15 minutes of that open is quite volatile, and we can define that range. That range, you see NYSE there, the tag is in green, so it's a green bias. We defined the range is in green, so we're looking for a long. But at this point here, you can see the yellow is above the red on the EMA. So if we've got confirmation checked on the strategy when we've been optimizing, this will now revert to that confirmation strategy, in that it will go long, and it will stay long as this yellow EMA stays above the red. When it crosses, it will close. You will still get the trailing stop. Sorry, not the trailing stop. The risk-free activation. So you'll still be risk-free. On YM, it's probably at 35 ticks. As soon as it goes through 35 ticks, we'll be at 5 ticks risk-free. That will still happen. So you'll be risk-free, and then you'll just let it run. See also down on the P&L subchart, we get the black vertical line. That's when we reset the profit. But again, we're already in this trade, so the profit doesn't reset because we're still in there. So we go through actually the close of that session. So this is where on those general settings, if we'd have clicked close on the end of the session, it would have closed, around about here somewhere. Whereas if we enable it to be carried through, we continue to get that runner, and eventually you'll see here sell confirmation exit. So it's that confirmation strategy where it takes that profit. Very, very powerful. And again, as default, depending on the type of strategy for the opening range for this first module, this is a really good strategy to have, because if the confirmation isn't present, it will revert to the targets you've set anyway. So that's that first module with that opening range. So the next module is reversal trade. The strategy looks for trades that are the reverse of the opening range bias. For example, if the opening range is green and the price action turns down suddenly, then we want to trade the reversal at the bottom of that range. So it's important that you run this module on its own on a different chart to the opening trade, opening range trade as well, and the next module, continuation trade. So this will be the only enabled module on that chart if you want to look for reversals. It's the strategy that you're looking for. So number 16 enables as default, but if you're running open trade and or continuation trade, it should be unchecked. Again, they all come checked as default. If you're going to run the reversal trade, the other two, the opening trade and the continuation trade, should be unchecked. So let's go through some of the particulars for this reversal trade. So the max first move size, this is the percentage of the opening range. So the default is 0.75, which is 75% of that opening range. So this means the initial move in the direction of the opening range bias is no more than 75% of the opening range. This can be adjusted during optimization. Number 18 is the minimum first move size. So this is a percentage of the opening range. The default is 0.1, which is 10%. So this means that the initial move in the direction of the opening range bias has to be at least 10% of the opening range. If you change the figure to 0, then there is no minimum requirement. So, and if the direction changes within the opening range, you will still catch the reversals. I'll go over this in more detail when we do the optimization masterclass. Number 19 is the maximum bars after opening. So this is the amount of candles or bars after the opening range that the reversal strategy will be live. Default is 10. But you could change it to 3 if you only wanted those immediate reversals, for example. So in this case, it's set to 10 as default. So once it got past 10 and it didn't reverse, if there was, or if there was an order on, it just would be cancelled, because you can, when you're optimizing, you can actually see and understand that behavior, and you say to yourself, if it doesn't happen within 3 candles, it's going to be a lower probability. I only want it to do it straight away. So number 20 is like the opening range module. This max range size is where you dictate the maximum size of the opening range in which you want the auto trader to work on this reversal strategy. If it goes out of your maximum, we'll just not put any orders on. The default is 0, which means no maximum range, so be aware of that. 21 is the number of contracts you want to put in the initial order to enter the trades. The remainder are the same as the, in the first trading module, the order type, the entry offset, the stop loss offset, break even trigger, that sort of thing. They're all the same that we just talked about in the opening range. Number 22, this is the only exception. You should always keep this to target mode when trading the reversals, because to be honest, when we are reversing, 9 times out of 10 the EMAs would be in the wrong condition for a confirmation trade anyway. So always keep that on target mode. So let's go and have a look at charts so you can understand it a little bit easier. Okay, so this is YM on the 15-minute, and we have a reversal. So we have the first 15-minute candle produce a range with a bias of green. We have the NYSE that's labeled in green, but then we have a red vertical line on, because remember we're looking for reversal. So we can see the price action initially moves out, doesn't go beyond 75% of the opening range, goes more than 10%, then starts to come back down and reverses down to the other side. We are 1, 2, 3, 4, 5, 6, 7, 8 candles. So if we're on that standard 10, that trade is fine. It comes out the other side, hits target 1, hits target 2. Remember, we're not looking for confirmation trades here because we are reversing. You see, as the opening range opens, we get the yellow is above the red, so everything's bullish, but it reverses. Some data comes out and it reverses that direction and comes back out the other side. So EMAs always, even though we have them out in front by 4 candles, they're still very slow to react. So we only use those target trades: entry, target 1, target 2, out, and that's what we're looking for on those reversals. So another example here is we get gold. Now this gold is set at 8:30 a.m. EST. So what happens is, on certain days of the week we have data coming out. So this is labeled data, so we can change those labels if you want them. We did talk about that in the general settings bootcamp, the first bootcamp. So what happens here is at 8:20 the gold pit opens. At 8:30, say for example on a Thursday, we get employment data out. So we're looking for reversals. So from 8:20, so it's a 10-minute time frame. From 8:20 to 8:30, we define that 10-minute candle range. It's actually, the bias is red. So we're looking for the reversal to the upside. So we get that, we're only looking for longs, the reversing out, and it does. Entry, target 1, target 2, target 3. So again, this is in that custom session section where we've changed the name to data, and the start time is 8:30. And remember, going back to that first bootcamp, that 8:30 is when the candle closes. So we've actually looked at that 10 minutes leading up to the data after that gold pit open, and the data's come in, it's reversed straight around, and we've traded that. So again, the reversal can be on a standard opening range. So for example, an index opening range, it does it and then it just reverses around. Or more particular and more powerful are those data opening ranges, and you're looking at defining the range before that data comes out on a, whether it's a currencies future, a metals, or an oil. You could use oil for the oil inventories on a Wednesday, for example, and we'll look at that using one of those examples in the optimization masterclass. But this just goes to show you how powerful it is that we define that range, and that the bias for this is after that gold pit open is bearish. So with the reversal strategy, we're only looking for the longs when the data comes out. The data comes out, price action reverses straight away, and we take the trade. So in this case, we've got those reversal trade settings 0.75. So in this case, the minimum first move for me is going to be 0. So it doesn't have to move out of that range to the downside before we get the reversal, because on data sometimes that range is defined, and as soon as that candle closes, data comes out and there's a reaction. So sometimes it won't even go down. So we need to make sure that minimum first move is set to 0. Maximum bars after opening is 10. The maximum range is 0 for me, because when I'm doing these data reversals, it doesn't really matter what that range is, and to be honest, leading into data, it's usually pretty small anyway. So with this, we've got the entry quantity 3. The order type is a stop market. Entry offset is 2 ticks. So this entry here is 2 ticks above the high of that opening range candle. Break even trigger was at 15 ticks. So as soon as we moved through 15 ticks, my stop was placed at 5 ticks, locking in, $150 worth of profit there because I've got 3 quantities. So again, we're in the target mode here. So the first contract was taken off at 20 ticks, giving me $200. The next contract was taken off at 30 ticks, giving me $500 in total. And then the next one was taken off at 80 ticks. So that's a $1,300 trade in less than 20 minutes. Very, very powerful. And this only happens once or twice a week. So if we don't get a reversal one week, we don't need to be downhearted. But the data shows us that when there is a reversal, it's very powerful, and when we're optimizing, we can make the most of those. So even if we get to a month, that's fine. Two at $1,300 is a pretty good strategy, because you're going to run it alongside other strategies as well. So continuation trade is the final module, and this is where the price comes back through that initial opening range later on in the session. So the options for this are the same as the opening trade options. So let's take a look at the chart now. So everything's exactly the same, and we can choose whether it's confirmation or target. For me, I always like to put the exit mode on confirmation, just in case we do get a runner. So let's have a look at the chart. So we've had the New York Stock Exchange open. We've had the London Stock Exchange open down here. So these ranges are defined and will continue as a range on your chart until the next open, 24 hours later. So we can see the New York Stock Exchange opened here. The opening range trade, we were looking for a long. It didn't happen. It came down. Okay. On a different chart set, we could have had the reversal there, and that's what you saw on that previous reversal chart set. We start to come back down through here, and we are entering the London opening range. Okay. Now that's when we get this red vertical line. Okay. Red vertical line with an order to go short. Couple of 2 or 3 candles later, it does break out that to the downside. So this is a confirmation strategy, purely because the yellow is below the red. So we're already in a strong bearish bias, if you like, with the range, but also the confirmation. So it's a confirmation trade and comes all the way down. So at this case, we had a session close, and it was enabled to close the trade at the session close. It was as simple as that. But the main thing I wanted to show you here was that we've got that continuation trade, but it's a confirmation type trade because of these EMAs. So it's not necessarily whether it could be continuation on that New York Stock Exchange range, but again, indexes react around other ranges as well. The London Stock Exchange is at the same time as the European Stock Exchange, so there's a great deal of price action around that range. So we must endeavour to keep those on our charts and allow to trade those as well. Let's take a look at another example here. So in this case, we've had this standard opening range trade, the New York. This is NQ. We've had that first 15-minute. The NYSE is labelled in red. The range is in red, and we have gone and hit that first target, and it's taken us out. Okay. Again, with NQ, we're only looking for short bursts, short targets, but it's still worth a considerable amount of money. So this target is approximately 100 ticks. So we get the opening range, next candle comes in, takes the target, boom, done. Okay, purely because at this point there's no confirmation trade, because the yellow is above the red. It needs to be below on the signal candle for that continuation. So it automatically reverts to the target. We're only on a one contract trade here because there's risk with NQ. Takes 100 ticks, out, gone. Comes back up through here, but look, it doesn't take this continuation trade because remember, when we're grayed out at the bottom of the chart here, this means it won't take a trade because when we've optimized, there's certain windows that this is good for trading. So it doesn't take this continuation trade here, and that's fine because over the 60 days or 90 days we've run the back test and optimizing, a lot of these will fail. Comes back down through, back into the range. This candle closes. Now we get a continuation order because the bias is red. We've got no gray on the bottom here, so it's active. Okay, it's in its session. We get the order, hits the order, takes the target, takes the profit. And further on, we do get some orders where we close in here, but it never takes the trade. The orders are just cancelled because it never takes the trade. Okay, so the next module for this is the session opens that you want to trade. So the first four are preset. So on 23, we've got the European Gold Pit Open. This is the first preset session, if you like. We have 6 in total. And the only one that's enabled by default. So you see at 24 here, this session is enabled. So that's the only default. Obviously, when you're looking at trading specific sessions, again, we'll go through that on the optimization. You can uncheck that, check London, for example, and that sort of thing. So the open for the European Gold Pit Open is at 2 a.m. So notice how item 25 is set to 2:05 a.m. as this is when the first 5-minute candle closes to define that range after the open. So yes, you guessed it, for gold we use the 5-minute time frame for this strategy. Most metals will be the same. So 26, this is checked as default and shows the label in this case European. It'll put that label that we just seen on those charts there where we saw NYSE and oil and things like that. 27 just shows the lines and the fill, and it's set as default the extreme of the opening range and fills in and shows on the buyer, so it shows on your chart. So 28 is the London Stock Exchange Open. That's next. This is also the European Stock Exchange Open as well. So 3 a.m. is the open, but the time here is set to 3:15 a.m. because that's the close of that first 15-minute candle. So as you guessed, we use the 15-minute candle time frame for trading indexes. Number 29 is the New York Gold Pit Open, which is at 8:20 a.m. EST. But again, notice the time is set here to 8:25 because that's when the candle closes. Again, we are trading gold on the 5-minute time frame. Number 30 is the New York Stock Exchange Open label. For that US Open, again, the time is set to 9:45. US opens at 9:30. That 15-minute candle closes. We've defined that range. So please note that all the timings are Eastern Time USA. So all optimizations for any instrument needs to be in that time zone. So those that have their computers or VPSs outside of that time zone, you need to change the time on your system to Eastern Time so that NinjaTrader follows that same Eastern Time zone. Very, very important. So custom sessions are the next. I mean, you can change those 4 as well if you want to do something else, but you've got 2 extra sessions for custom sessions, and these can be adjusted to whatever instrument you're trading and even a specific economic data point like jobs data. So in this example on the right at 33, we have the oil pit open, which is at 9 a.m. EST with the time set at 9:05. So you guessed it again, energy futures are best traded on the 5-minute time frame with this strategy at their open. Okay, that is a bit of a caveat there. And then number 35, this is the Wednesday oil inventories data, which is set at 10:30 a.m. EST. So the setting is at 10:35. Now this is a very volatile point. So when optimizing for a data reversal, you may need to increase time frames, but we'll cover that more in the optimization masterclass. I just wanted to show you those specifics. For you can type in whatever you want for that customization. Just click in there, type it, change the time, make sure that you show the labels, show the lines, show the fill, and you'll be able to for example, put anything in there as long as you understand what the data point is and you're looking at where the candle closes for that particular data point. So let's move on. So this is a pretty standard oil data point. So this is when what happens is we get that oil data at 10:30 EST, oil inventories on a Wednesday. And what we look to do there is when this was optimized, I actually found that 10 minutes was better for this because it was more volatile. So we get that candle close, and then what we're looking for is the reaction to that data. So the candle actually closes at 10:30, so we're defining that 10-minute period before the data comes out. In this case it was a bearish bias, so we're looking for the short order, and then we get the short order comes in with the reaction to that oil inventories data. Target 1 hit, target 2 hit, target 3 hit, all in the same candle. Don't be greedy. When you're optimizing, you need to understand where those targets are. And we entered at 93.10. First target was at 10 ticks at 93, and then 25, and then so on and so forth. So don't be greedy because they won't always run like this. And this was part of a straddle strategy that I've developed for the oil data point, where we're looking for a breakout in regards to the session. So when that data gets announced, we're looking to trade in the direction of that bias, but also there is another option where we look to trade in the reversal. So again, I've called it oil data. I want to start the start time, so when the candle closes at 10:30 a.m. as that data comes out. So when this range is defined, it's that 10 minutes leading up to the data. So at that point it's going down, then the data comes out, and that continuation happens, and we get the breakout of that range, and that's what we got set there. So again, this is slightly different. There's no max range on this because it's a data reaction. I've put three contracts on. Entry offset is 1, really aggressive with this entry offset here. Stop loss offset is 2, and then break even trigger is very, very aggressive here. So as soon as that move goes through 5 ticks, I put my stop at 2 ticks profit. Okay, so all I'm looking for is a reaction, a fast reaction, straight down or up. It doesn't matter. But as soon as it goes through 5 ticks, my stop goes on. So I'm being very aggressive with that, but that's protection. That is safety. Again, the exit mode is target. Target, the first contract goes off at 10 ticks. The next contract profit 25. The next contract is 40. Very, very simple. Don't overcomplicate it. Just look for that reaction. Again, once a week. But when you add that once a week of oil to that once or twice a week on gold, those data reactions, they start to add up. So this is the opposite way round. So this is another example of another day where we get that first 10-minute candle defined. Okay, again, we've got that candle closing at 10:30 a.m. But this time we have a bearish bias, okay. But we've got the reversal chart now, with reversal strategy. We have 0 on the first move percentage because we know as soon as that data comes out, if it reverses, we want to get in it. No max range. We're entering 3. Entry offset this time is 2 ticks because the reversals can be quite aggressive, and sometimes when you just need that little extra just to help us get in and get less slippage. Stop loss offset is 2. Break even trigger again, just like the breakout, very, very aggressive at 5 ticks. As soon as that 5 ticks get hit, we put the stop 2 ticks in profit. Okay, target 110. The next contract is taken out at 30. The next contract is 80. We usually find that the reversals are more powerful than the breakouts after that oil inventories data. Again, we're exit mode is target. So what we're looking for again is we're defining that 10 minutes before that oil data comes out. It's a bearish bias. So I've got 2 chart sets. If you look at the bottom here, I've got CL data B, which is breakout, CL data R, which is reversal. So I've got both running at the same time on different chart sets. One for the breakout, on one for the reversal. We're basically straddling that opening range, and it'll take one or the other, or sometimes it'll take both. It'll take it in the direction of the breakout, might take your profit, come back, reverse, and take the reversal in as well. So we've set up for that particular point in time. And again, when we go through, when we did that first module on that boot camp where we looked at those session times to do, we'd only put Wednesdays between certain hours, and that's the only time we're interested in trading this particular strategy. So very, 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 very powerful strategy, the reversal trade there. Okay, so that's the xBrat range breakout auto trader optimization. Now we're going to go to that optimization masterclass next, because it's important to understand how we can optimize for those different modules, whether it's the opening range, the continuation, or indeed the reversal. We've seen some examples in this particular bootcamp, but now we need to get down and dirty and go through the optimization process to figure out a really sort of sensible strategy that doesn't take too much risk. So I'll see you in the next session.